Imagine someone tells you, there's a new stock hitting the market this week, and all you see is a name, a ticker, and a tiny price range. That's not enough to know what you're buying. On the cursor stocks, Coolbit Technologies is a useful IPO story because the central question is simple. What would have to be true for this IPO to make sense? The company is Coolbit Technologies Ltd, and it's expected to trade under CBAI, the short stock market nickname people use to find it. It's set to list on the NASDAQ on June 26, 2026. The offer is still pending, so these are planned deal terms, not a final trading history. An IPO is the moment a private company starts selling pieces of itself on the stock market. Those pieces are shares, tiny ownership slices of the company. Coolbit is aiming for a range between $4 and $5 per share, but that number alone is like seeing a price tag before you know what's in the box. The plan is to offer 5 million shares and raise about $25 million. If you divide the planned raise by the shares offered, the expected price works out to around $5 a share. So this is a smaller IPO, not a giant household name listing, and that makes the business story even more important. Here's the part that should slow everyone down. Coolbit's public profile does not clearly explain the everyday product, the customer, or the problem it solves. That doesn't automatically make it bad, but it means the viewer has to resist the easiest trap in IPOs, liking the idea of a new stock before understanding the actual business. Think about that price tag idea again. If you walk into a store and see something costs $5, you still need to know what it is, whether it works, and whether anyone else wants it. A share price works the same way. Coolbit's share price range is visible. The operating story is much harder to see. For a company going public, the first questions are usually basic. Who runs it? When was it founded? And where is it based? Those details help investors judge whether they're looking at a proven operator or a brand new name. For Coolbit, those background pieces are not clearly available in the current profile. That brings us back to the question, what would have to be true for this IPO to make sense? At minimum, Coolbit would need a product people can understand, customers who pay, and a reason those customers might keep paying. Without those pieces, the $25 million raise is easier to describe than the company itself. The deal size changes depending on where the final price lands inside the range. At $4 a share, selling 5 million shares would bring in about $20 million before fees. At $5, it reaches the stated $25 million deal amount. For a small company, that extra $5 million can be meaningful growth fuel. Why does a company go public at all? Usually it wants cash to grow, more visibility, and sometimes a path for early backers to sell later. But public money comes with public questions. Once a company asks regular investors to buy in, it has to make the story clearer than a name and a ticker. Market cap means what the whole company is worth on the stock market. For Coolbit, that full IPO valuation has not been set yet. That's important because a $5 stock can still be expensive if there are many shares behind it. The real price tag is the whole company, not one share. This is where a beginner can already think like an investor. Don't ask, is $5 cheap? Ask, what am I paying for? If the business later shows strong revenue, loyal customers, and improving losses, the story can become easier to judge. If those pieces stay vague, the low share price doesn't protect you from confusion. Revenue is the money coming in before expenses. Profit is what's left after the bills are paid. Coolbit's latest full-year revenue and net income are not clearly available in the current profile, so the financial reality is a blank scoreboard. You can watch the game, but you don't yet know the score. The bull case has to stay careful. A $25 million raise could matter if Coolbit already has a real product, paying customers, and a market where more cash helps it move faster. The hopeful version is that a quiet company is about to become easier to see. But hope is not the same as proof. The bear case is just as easy to understand. When the business description is thin, investors are asked to accept more uncertainty up front. Maybe fuller documents reveal customers, revenue, and a strong plan. Maybe they don't. That uncertainty is not a footnote. It's the main thing a new investor should notice. Competition is another place where guessing would be fake precision. Until Coolbit clearly explains what it sells, naming rivals would make the story sound more certain than it is. Every business has alternatives, though. Sometimes the rival is another company, and sometimes it's the customer deciding not to spend at all. There's also the question of who gets the IPO money. Sometimes new shares send cash into the business. Sometimes selling shareholders cash out. And a lockup, a waiting period when early insiders usually can't sell their shares yet, can affect supply later. For Coolbit, those details are follow-up questions, not assumptions. After it lists, watch 3 simple signals. First, does Coolbit explain what it sells and who buys it? Second, does it report real revenue and whether losses are manageable? Third, does management show how the IPO cash is being used? Those answers matter more than the first-day stock move. So the balanced verdict is this. Coolbit's IPO is understandable as a small public raise, but the business story still needs to become much clearer. The dream is that investors are seeing an early company before the crowd notices. The doubt is that too many basic pieces are still blank. The useful lesson is bigger than Coolbit. Next time a new ticker appears, you know what to ask. What does it sell? Who pays? What are the numbers? And what could break? Follow the cursor stocks for IPO stories before they trade. This video is for information and education only, not financial advice.